Hey everyone, welcome to the KE Report, another daily editorial as we are chatting with Jesse Felder, founder and editor of the Felder Report. Jesse, we're going to start off with the commentary on the US dollar and then tie that into commodity moves, which in all fairness, it does seem like a lot of the commodity momentum that they had to the upside has really waned, especially after the election. And US markets, hey, they just keep on hitting all time highs. I know you think this is one of, if not the largest bubbles in history, so something for us to talk about there. But Jesse, starting off with the US dollar, look, it bottomed just below 100 on the dollar index back in September and has moved, in a way, almost straight up over the last month and a half to 2 months. In the last week, though, we have seen a little bit of weakness from that 108 level, but again, dollar has been strong. Jesse, why has the dollar been so strong in your eyes?
Well, dollar strength has been, driven by, a lot of different things. I think it's mainly been the fact that, the Fed has been raising interest rates until very recently, right? It's over the last couple of years, we went from 0% interest rates here in the US to 5% and change. And I think that's driven a lot of flow into US assets and pushed the dollar higher. I think also, obviously the US economy has been the one area of strength around the world. China's, suffering. Europe's economy is not so great. And so, the US economy has held up very well, relatively speaking. But I wrote a piece for my subscribers over the weekend about how the dollar, I think, holds the key to all the markets going forward, whatever you're talking about, stocks, commodities, bonds. Typically, when you have a dollar bull market, or at least over the last several decades, 30 plus years, it's coincided with a bull market in financial assets. So you look at, dollar rose, very strongly from the early 90s into the 2000 stock market top. Obviously, that was coincided with the dot-com bubble, and commodities did really poorly in the late 90s, right? Oil price, gold prices just, went in the toilet. After about 2001, 2002, dollar reversed lower and stocks went into a lost decade, right? After the peak of the dot-com bubble, you had no return from stocks over the next 10 years. What did well during that dollar bear market that lasted from about 2002 to 2012-ish? What did really well during that time frame was commodities, right? Oil and gold and these things did phenomenally well. And so we've had another dollar bull market really since 2012-ish, was when the dollar bottomed, and it ran strongly higher into the last few years. But I do think we're potentially at a point in time, there's a number of factors that cause me to say this, that the dollar is potentially in a topping process. And if that's the case, then it would suggest that this bull market for financial assets that we've seen over the last decade plus is potentially reversing. And the relative weakness in commodities, which potentially ended back in 2021-ish, 2020, is turning into a bull market, a secular bull market for commodities. I think that those trades could reassert themselves if we start to see some dollar weakness here again. And there's, like I said, there's a number of reasons to expect dollar weakness, I think, in the months and quarters ahead.
Well, let's dive into that topic a little bit further, Jesse. So, if the dollar is getting near a top and starting a structural decline, what signals are you looking for in the general stock markets to tell you we are kind of getting in nosebleed territory? I know that you've been talking about what insiders are doing, but there's other metrics you look at as far as breadth indicators, valuations themselves. If you just look at it, what has your attention as far as could be indicating that the U.S. equities are getting near that top with the dollar?
Yeah, well, we are at the most overvalued point. I think by the most valuable measures in terms of measuring the valuation of the stock market. And I'm not talking about like a trailing PE or forward PE ratio, which are both of those are very high relative to history. CAPE ratio is another one that suggests we're near the all-time highest valuation. But if you normalize for profit margins and things like that, which are typically mean reverting, we're at the highest valuation for the stock market in history. Buffett yardstick just says the same thing, market cap to GDP. And so does, Tobin's Q ratio, which is just price to assets. So price to sales, price to assets, these type of things suggest stock market is most overvalued it's ever been in history. But, to bring it back to the dollar, if you just look at the dollar also on a purchasing power parity basis, we're on the high side of history as well, where it would suggest the dollar's 15 to 20% overvalued relative to the DXY basket. That is also just like that measure of valuations, price to sales and things, is a really good predictor of 10-year returns in the stock market. High valuations lead to very poor returns going forward. Same thing in the dollar. An overvalued dollar has a very high correlation with negative 10-year returns for the dollar index. So this would suggest over the next 10 years, dollar's likely to have a bear market just on valuation alone. But things like the fiscal deficit, which is already very wide, 7% of GDP or something, and only expected to widen further, is potentially a catalyst to create that dollar bear market. So I think we have an overvalued dollar, an overvalued stock market, and those things kind of go hand in hand right now, suggesting that the trade for equity bull market is very long in the tooth and potentially poised to reverse.
Jesse, what do you say to people that say, I've heard this. I've heard that these markets are overvalued. I heard that there needs to be a correction, but these markets have just kept on going higher, and I've been sitting in some of these other assets or sitting in cash, and I've been left behind.
Yeah, I mean, that's exactly what bull markets do, is they create the fear of missing out that forces everybody to pile into the market at the wrong time, right? It's the famous Bob Farrell quote: "The public buys the most at the top, right, and buys the least at the bottom." That's just how the markets work. And what we've seen is the greatest 12-month inflows into ETFs, the greatest 3-month inflows into ETFs over the last few months, when we have the highest ratio of leveraged assets into leveraged long ETFs versus leveraged short ETFs. The only time it's ever been this high was November of 2022, right when the market was peaking. 2021, when the market was peaking and rolling over into that bear market of 22. So everybody and their mom has piled into leveraged, U.S. equities. Another one that to me is just astounding is small speculators in S&P 500 futures. It's literally like 10 times higher than anything we've ever seen. Non-reportable traders in S&P 500 futures are the most extreme long we've ever seen them, and by a huge margin. And so all signs point to the fact that people are way overinvested into the U.S. equity market at a time when not only are stocks extremely overvalued, but there are some technical and fundamental signals that we could talk about too that are more important in terms of timing than valuation might be.
Well, Jesse, what do you also make of, in tandem with the dollar screaming higher and the U.S. market screaming higher, we've also seen the cryptoverse back on fire again, that speculative bid outside of the U.S. equities, although there are some crypto miners in the U.S. equities that have also been screaming higher. What do you make of cryptos like Bitcoin and Ethereum and the crypto miners scorching higher along with these markets?
I mean, it's a good point, because to me it just points to the animal spirits, the speculative fervor in the markets right now that's really just off the charts. I mean, you can see that in terms of sentiment signals. I think it's the Citi panic euphoria measure literally went off the chart to the upside last week, suggesting that we are in well into euphoric territory. But when you look back at prior bubbles in markets, whether it's the Japanese stock market bubble in the late 80s that peaked in 1990, or the 1920 stock market bubble, there's a kind of a famous thing that you see, which is companies decide. I mean, here's a quote from the Great Crash 1929. "A few firms made this decision. Instead of trying to produce goods with its manifold headaches and inconveniences, they confined themselves to financing speculation." Here's a quote from the 80s Japanese stock market bubble. "The frenzy reached such proportions that many leading manufacturers, such as carmaker Nissan, made more money through speculative investments than through manufacturing cars." This is exactly what MicroStrategy is doing, right? They've decided that their software business is too difficult to pursue in a profitable way. So what do? We're going to turn to speculating in the financial markets. We're going to bid up Bitcoin by, selling equity and convertible debt in order to leverage our balance sheet to this cryptocurrency, in kind of a self-fulfilling, positive feedback right? We're going the stock MicroStrategy stock keeps going higher because speculators keep buying it, giving them cheap capital to go buy Bitcoin, which pushes Bitcoin price higher, which is pushes MicroStrategy price higher. And it's just a speculative frenzy. That's really the type of thing you only see near peaks in major bubbles.
Jesse, what are your thoughts on the crypto market in general? It's been around now for, I think, long enough that we can say it's built up a following of people that will actively trade it, but we always hear the argument, what's truly underlying Bitcoin? It's nowhere like gold. It's not a store of value. It's a leverage play on tech. People say there's nothing behind Bitcoin. It might just blow away. But then there's also these people saying, I told you that Bitcoin was going to hit 100,000, and now I have some even higher $1 million targets for you. How do you view broadly the crypto world?
I really think that the best characterization of it is digital tulips. I think that there really isn't anything underlying it. It does trade just like a high beta, risk asset, like, leveraged QQQ. And that hasn't changed at all. Its character is it trades like a highly leveraged risk asset. And so to me, that means its primary use is as a speculative vehicle. And that's how it's being used. I mean, you look at the flows into not just MicroStrategy, you look at the flows into the leveraged MicroStrategy single stock ETFs, into the Bitcoin ETFs, all these things. People aren't buying it as a store of value. They're buying it to speculate on higher prices. And so I think that's fine as long as people recognize, yeah, it's a wonderful speculative vehicle. But I think in terms of as a core holding in an asset allocation model or store of value, it makes no sense.
Well, Jesse, let's pivot over to the sector that has lagged, or I guess the area of the markets that's lagged, and that's the commodities. In general, there's been some nice runs in gold and silver over the last couple of years, and oil's had a good couple of years ago, but then has been selling off the last couple of years. The oil stocks have remained high. Copper's had a nice mixed bag, but when you look at just the commodities from a longer range lens, like you were laying out, in lieu of what's happened in the U.S. equity markets for the last 14, 15 years, in lieu of what's happened in the dollar, if those are getting ready to turn down, do you really see a decade of growth in the commodity sector?
Absolutely. I mean, I look at one of the charts that I've been looking at just for the last few years is just the long-term oil price chart, monthly chart going back, I don't know, 15, 20 years or something. And you can see a long-term downtrend channel, formed from its peak over a decade ago. You peaked around 2011-ish. 2008 before that, I think it went even higher. But we've had a downtrend channel since that kind of 2008 timeframe. Obviously, we bottomed in 2020 below zero on the oil price. Oil prices went negative. And that's about as bearish as you could ever imagine the oil price getting. But the reversal higher in 2020, 2021 saw the oil price break out of that downtrend channel. And whenever, Paul Tudor Jones has famously said, whenever you see something break out of a range, it's a very strong signal that price is going to continue in that direction. So that breakout to me in 21 and 22 was a very clear signal that the long-term secular bear market in the oil price was over. And we're now watching the beginnings of a new secular bull market. Since that time, right, oil price peaked in early 2022 and has essentially consolidated. It went straight down in early 23 down to that $65 a barrel. And we've essentially traded sideways, for the last year and a half in the oil price. To me, that's a very healthy consolidation after a very bullish breakout. And so I think just from a technical standpoint, you have to look at the oil price and say, we've seen this major breakout. We've just consolidated those gains. And now, like I said, I'm looking to the dollar to let me know when it's likely that we're going to see the oil price start to take off again.
Any insights, Jesse, on why the oil stocks, you look at the major oil stocks or even the ETF that follows them like XLE, that is right near all-time highs, even while oil is well off from some of the highs from this year, let alone the last couple years. But we look at other resource sectors, and I can't think of very many outside of maybe uranium that the stocks are doing as well as they are in a let's say, slowing or flat price environment for the underlying commodity?
Well, I'm still very bullish actually right now. I'm tactically bullish also on the energy stocks, namely the oil and gas producers. I think what's going on here is, we saw from basically 2015 through 2021-ish that $65, $70 represented a ceiling on the oil price, a pretty hard ceiling for almost a decade. And after that breakout that I mentioned, we're now seeing the $65, $70 level serve as a floor for oil prices. And if that's the case, because I mean, right now, look, we have oil prices sitting on horizontal technical support that goes back 5, 6 years, pretty clear horizontal support level. But sentiment is extremely bearish. Positioning in the futures market, it was recently as bearish as it's ever been in history in terms of, gas oil combined futures. Managed money positions were massively net short, more than they've ever been before. So sentiment is very depressed. Demand remains relatively strong, and oil inventories, are testing the low end of their range. In you look at the last 5 years, inventories are very low. Demand is strong. We have kind of technical support and very bearish sentiment. So I think what the oil stocks are reacting to is this is likely a floor in the oil price. And if the dollar, like I said, does roll over, oil prices turn higher. The fact that oil stocks look cheap today is only going to look even more dramatic if you see an upturn in the oil price in the months ahead. So, these stocks are right now about as cheap relative to the S&P 500 as they've ever been. And, like I said, the oil price is essentially like, an upside option for these companies that in terms of their earnings. And so I think that that's what's going on with the energy stocks. In terms of miners and gold and stuff, I've been really surprised, honestly, how poorly the miners have performed. We were talking before we went on, started recording, that there are companies that have done well, and, companies that we've discussed in the past, namely Agnico Eagle. But with the strength in the gold price over the last 12 months, right? We've had a huge 12 months move higher in the gold price. You would think that the gold miners would be outperforming the S&P 500, not underperforming. They've significantly underperformed. And when you see that kind of a divergence, when I see that kind of relative underperformance of the miners, even in the face of gold strength, it's usually a sign that investors in the space have gotten too bearish, and it's actually a pretty bullish, contrarian sign for the months ahead.
Well, when you look at that divergence between how the gold equities have done versus U.S. equities and even versus gold, do you think there's something fundamentally different about this particular rally? Because, Jesse, we keep hearing people say, well, in the past, you could speculate in the gold mining stocks and that hot money came in. Now there's a million different choices between cryptos and meme stocks and biotech, and there's all these leveraged ETFs that you can play that are 3x moves, and you can get into the options market. Has the market fundamentally changed where gold equities are just not going to garner that same kind of attention again? Or have people become too complacent and thrown the baby out with the bathwater in the sector, and maybe they'll be surprised to the upside?
Well, I don't think there's been a fundamental change, but I do think you've made a really good point about, nobody wants to trade the miners when they can trade two-time leveraged MicroStrategy ETF, right? Which is going to move, 20-30% in a day. The speculators' attention is clearly focused on crypto right now. And this is how these things have traded, right? When crypto's hot, miners aren't. And that's just kind of where we're at. I don't think that's a fundamental change in the market. I think it speaks more to this phase of the bull market that we're in. And I do think this is a blow-off move higher in these types of speculative names. If that's the case, and they're going to, and just look at that, I mean, to me, the relative weakness in the semiconductor space is something to pay very close attention to. It's been the leader in the stock market really since, the bottom a couple of years ago. And the fact that the relative strength has turned into significant relative weakness, and you can just look at NVIDIA over the last, week or two, is starting to actually play along with the semis in terms of relative weakness. That tells me that, that we are late in the game in terms of risk appetite in the equity space generally. So I think what would drive interest in the miners again is, yes, you have to kind of take away some of these other playthings that traders are focused on right now. You take away the crypto, you take away, the semiconductor stocks, and super micro is, one we could look at today. That is, kind of like this glittering, twinkly eye candy that is distracting people from things like the miners. Take that away, and you'll get traders piling into the miners again. I mean, like I said, gold price has gone from 1850 to 2700 in the last 12, 13, 14 months, and the relative performance of the miners is flat. That's a really kind of rare thing to see, and I will say too that I'm talking about not just the performance of the miners, I'm talking about the relative performance. So miners versus S&P 500 means that can improve by one of two ways, right? Miners go up or S&P goes down. And so I think that ratio of miners to S&P I'm bullish on that ratio. And that's just, I want to own miners and avoid S&P, in this type of environment right now.
Well, we will see how it all plays out, because we were just talking to more of a chart trader guy, and he was saying that money very well could be going back into some of those high-flying tech stocks and carry the market, or even show a little bit of weakness, but still that rotation. We'll see where these markets go, Jesse, but look, there is still a lot of money to be made in these markets, and it has been very strong. So, hey, maybe a correction is due, but well, it is due, but who knows what that's going to look like. And if money finally will ever go back in the way it used to some of the old school assets like gold and other commodities. But hey, there's always something shiny out there for investors to look to. Jesse, always great chatting with you again. Jesse Felder, founder and editor of the Felder Report. Click that link in the show notes to follow along with Jesse. Jesse, great chatting with you. Thanks for your time today.
Thanks, guys. Always a pleasure. Take it easy.